Good morning, everyone. We are excited to present on the topic bond market premium. Let me introduce our group members. I am Arisha Noor, the first speaker. Following me will be Alize Batul, the second speaker, and then Irha Tariq will conclude as a third speaker. We hope you enjoy our presentation.
Today, our group will be presenting on the topic bond market premium. As a student of economics and finance, we believe understanding the bonds is crucial because it plays a fundamental role in financial system. Throughout our presentation, we will explain the basics of bonds, how the bonds market function, the relationship between bond yields and interest rate, and the risk and benefit associated with the investing in bonds. Our aim is to give you a clear and concise overview of the bond market and its significance.
I will be introducing the bonds market. So, what exactly are bonds? Bond are debt instrument issued by a government, corporation, and other entities to raise money. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payment and the return of the principal amount at maturity. Now, types of bonds. There are different types of bonds such as government bond, corporate bond, municipal bond, and international bond. Government bonds are issued by a national government, while corporate bonds are issued by companies to fund their operations and projects. Municipal bonds come from local government, and international bonds are issued by foreign entities. Now, importance of bond market. The bond market is essential because it provides a platform for these entities to raise funds efficiently. It also offers investors a way to earn steady income and diversify their investment portfolios. Without the bonds market, government and businesses would struggle to secure the necessary capital for their activities and making it an important aspect for the financial system.
The mechanics of the bond market. How the bond market work. Now that we know what bonds are, let's talk about how the bond market works. The bond market operates in two parts, the primary market and the secondary market. In the primary market, bonds are issued for the first time directly to investors. For example, a government or company issue a bond to raise money. Once the bond is sold, it moves to the secondary market where it can be traded between investors.
Key players in the bond market. There are key players in the bond market, issuers like governments and corporations, and investors such as individuals and institutions, and intermediaries like brokers and banks who help facilitate transactions. Now, factor influencing bond prices. Bond prices is determined by several factors, including interest rate and issuer's credit rating and the bond's maturity. If interest rate rise, bond prices typically fall, and vice versa. This relationship is crucial for investors as they make decisions about buying and selling bonds. Understanding how the bond market functions is essentially for making informed investment choices. Thanks for listening so far. Now, I will hand it over to Elizabeth to take you through the next part.
Assalamu alaikum, this is Aliza Batul, and thank you Arisha for covered the basic information. Let's look deeper into the bond market. So firstly, I discuss the key concept in bond market. So there is two key concepts. current yield and yield to maturity. So the current yield is a way to measure the income you can get from the bond right now. It's calculated by taking the bond's annual interest and dividing it by the bond's current price. And the second one is yield to maturity. Yield to maturity is a way to measure how much money you can accept to make from a bond if you hold it until it matures. It considers the bond's current price and the interest payment you will receive and how long you will hold the bond. Yield to maturity helps you compare different bonds to see which one might give you a better return. Now we have the relationship between bond price and interest rate. So, when the interest rate goes up and the price of existing bonds goes down, this is because new bonds pay higher interest rate and making older bonds less attractive. Then the interest rate goes down and existing bonds with the higher interest rate become more valuable because the price goes up. So we find that there is an inverse relationship between bond price and interest rate. This affects how investors choose bonds and manage their money. So investors consider two main things, that is how to choose bond and how to earning money. If rate may rise, they buy short term bonds, and if rate may drop, they buy long term bonds. Investor thinks that the investment in bonds are too riskier because bond provide stable income but low interest rate. So these two main things help investor to take a smart decision. Now we have two indicators, that is normal yield curve and inverted yield curve. So normal yield curve indicates healthy growing economy. It suggests that investor expects the economy to grow because they want higher returns for longer term, because they believe that inflation will rise and business will perform well. But on the other side, there is inverted yield curve that indicates a potential recession. Investor may believe that economy is slowing down, so investor prefer a long term investment. So, investors use the yield curve to plan their bond investments based on what they think and what will happen to interest rates, helping them to maximize their returns. When investors invest in bond markets, they faces risk. Number one is credit risk. This is the risk that the issuer of a bond, like a government or a company, might not be able to pay back the money. If they go bankrupt or having financial trouble, you might not get your interest payment back or your original investment back. Number two is interest rate risk. This risk arises when interest rate in the market rise after you buy a bond. When interest rate goes up, new bonds are issued with higher rates, makes your older bonds less valuable. If you want to sell your bond before it matures, you might have to sell it for less than you paid. Number third is inflation risk. This is the risk that the money you earn from your bond will not keep up with inflation. If inflation rises, the purchasing power of your interest payments and the amount you get back at maturity may be lower than your expectations. Essentially, you might not be able to buy as much with your bond earnings in the future as you can today. Now we talk about the Pakistan's bond market in 2024. First, there are some positive signs. Pakistan credit rating has improved, which is encouraging foreign investors to return. The government is also focusing on infrastructure projects, and corporate bonds are helping the private sector grow. However, there are challenges. The country is dealing with high inflation and a large fiscal deficit, which makes things difficult. The value of Pakistani rupees is also unstable, which worries investors. In terms of numbers, the total bond market is worth 12.5 trillion PKR and 40 billion USD dollars. Government bonds make up 65% of this, while corporate bond account for 35% of this, and foreign investment is also around 15% of the market. While there are positive developments in Pakistan bond market, it needs to address its challenges for the future growth. Now Irha will continue the discussion. Thank you.
Assalamu alaikum. I'm Irha Tariq, and right now I'm going to explain you Pakistan's bond market situation in 2024. So in 2024, Pakistan's bond market shows an inverted yield curve, which means short-term bonds like 3-month T-bills have higher yields as compared to long-term bonds, around 14.5% to 15.5%. The 5 years Pakistan investment bond yield is slightly lower at 12.5% to 13.5%. And the 10-year Pakistan investment bond is even lower at 11.5% to 12.5%. This inverted yield curve suggests that investors are uncertain about Pakistan's economic future. often expecting lower growth or potential downturn, which drives demand for long term stability over short term bonds. The crucial question is, what are the benefits of investing in bonds? So, investing in bonds has several benefits. Firstly, bonds provide a stable income through regular interest payments, which adds predictability. They are also lower risk than stocks, especially government bonds, helping preserve your original investments. Bonds bring balance to a portfolio, reducing overall risk by diversifying it. Since interest rates on bonds are fixed, they offer predictable returns, which many investors find reassuring. Plus, in some cases, bonds come with tax benefits, making them an efficient choice financially. How can we compare bonds with other kinds of investments? So, to put bonds in context, let's compare them with other kinds of investments. Stock often offers higher returns, but they also carry higher risk and price volatility. Real estate, while relatively stable, requires more capital and doesn't offer the same liquidity as bonds. Bonds strike a middle ground, providing predictability and lower risk, making them suitable for conservative investors, all as a part of diversified investment strategy. Altogether, in conclusion, we covered the basics of bonds and their types, how the bond market operates, the relationship between bond yields and interest rates, and the risks and benefits of investing in bonds. Bonds are an essential instrument for raising capital and can offer investors stable return, but they also come with their own set of risks. Technological innovations are reshaping bond trading with increased fintech usage. Regulatory changes are also introducing new policies that impact the trading process. And lastly, there is a growing trend towards green bond and socially responsible investing. For further up to date information, we recommend you to visit Financial Times and Investopedia. So, we hope this presentation provided you with a clear understanding of the bond market and its importance in the financial system. Thank you. We appreciate your time and attention. Thank you again.